Welcome to today's event, Capital Markets Series, Private Markets, hosted by CFA Society Chicago Education Advisory Group. This is the second part of a four-part series. The replay of the first part on public markets is available on the Society's website and YouTube channel. Information on upcoming events can be found on the Society's website at www.cfachicago.org. All mics for attendees will automatically be muted during the event. If you have a question for our panel, please use the Q&A feature. This event is being recorded. Today's discussion will be moderated by Christian Barron, CPA, CFA. Christian is currently a Senior Business Development Associate with LQD Business Finance. They are a Chicago-based, tech-enabled private debt fund. Joining Christian for today's discussion are Mark Guinea, CFA. Mark is a Managing Director of Investment Strategies for Crescent Capital's California region. Harisha Hai, CFA, who manages the private investments and real assets portfolios for Northwestern University's $11 billion endowment. And our third panelist is Brady O'Connell, CFA, CAIA, a Senior Vice President with Callan, LLC. I will now turn it over to our moderator, Christian Barron.
Hello, everyone, and I want to say thank you again for joining us today. I also want to send one more reminder to post any questions that you might have in the Q&A button at the bottom of the screen. With that, we will begin. And the first question will be for Mark. From an allocator's perspective, what makes private investment vehicles so attractive?
Yeah, thank you. And just to be clear, my client base that I work with is predominantly high net worth families. So I may get a little bit of a different answer if I was talking with institutions. But one of the things I find very attractive in working with my client base in the private space is sort of four main features. One is inaccessibility. I sort of adopted the Groucho Marx school of investing. I don't want to belong to a club that'll have me as a member. And I can find that you can find much more differentiated strategies in the private space than you can in the public space. That being said, you could also find strategies that are much more capacity constrained because there's no asset that eventually can't destroy future returns. But I think you can much more control and or quantify the amount of assets in certain private strategies that you have a harder time with public strategies. But the second is the greater variability of strategies, so more the uniqueness of private funds that is just much more challenging with public strategies by and large. And the third is reducing what I call the common shareholder risk. You can get a better sense for not only the other investors or shareholders, but often the funds or the vehicles you're investing in have gates and other restrictions. So you don't have to worry about the emotional or psychological wherewithal of other clients capitulating at the worst possible time that you often have with the public markets. And perhaps the last is the ability to go direct, something that Crescent is sort of central to its founding, is the ability to invest directly in private companies or private real estate or private credits that that obviously you can achieve sort of certain characteristics, holding periods, and returns that you just can't get in other markets. So those would be the four main reasons.
And Harisha, I understand that you work for an endowment, which is slightly different than the client that Mark represents. Could you kind of elaborate the thesis behind your private investment strategy?
Sure. So in theory, endowments have an infinite lifetime, and so we're able to take more risk as long as we meet our spending obligations to the university. Northwestern, for instance, the endowment accounts for about a quarter of the university's budget. So we're able to have more of the endowment in alternatives, and let's say perhaps a pension fund or other institutions. In privates to us means anything that's in a liquid structure. So it could mean private equity, it could mean growth capital, it could mean venture capital, and the real assets could be assets such as properties within our real estate portfolio, or wells and E&P in our energy portfolio. So they all are similar in that they have long-term, typically 10-year or longer partnerships.
And Brady, I was wondering if you might want to provide some more color on how private investment strategies might fit the institutions that you represent and how that varies from Mark and Harisha.
Yeah, so Callan advises a lot of institutional investors, and I think the distinction I would make is when it comes to corporate or public defined benefit plans, some of the things that they find attractive in private market vehicles are first and foremost the higher returns than you might get from the public markets. Public pension plans in particular are challenged to try to meet their long-term return targets, and there's a premium to investors for tying up their capital in less liquid investments when we think about them compared to the public markets. So the higher return profile is definitely a benefit of the private market asset class. The second issue I would highlight is the improved ability to achieve success through active management. In the public markets, we discuss active versus passive a lot. In US equities in particular, it's very difficult to add value with active management. You can only use active management in the private markets, and I think there's a very compelling case that the term of the limited partnership vehicle is better aligned with the time horizon that you need to be successful with active management. So you get a premium for giving up liquidity, and then you can usually achieve a premium from skilled managers.
Okay, so with that being said, I'd like to kind of drill into our first segment of the private market asset class as a whole. And this question will be for Harisha, and that will be, what are the various different types of private equity investments? Do they serve a different purpose in your portfolio? And what is your outlook on these different types of PE investments?
Sure, so if we talk just about private equity, for instance, private equity can range from anything to buyouts, growth capital, and venture capital. Buyouts are traditionally more mature businesses. They actually have revenues and profits, and venture capital investments could be just a 10-page deck and an idea. And so they differ in many ways. Maturity, as I mentioned, is one. Profitability is another. And that leads to the ability to take on leverage. So buyouts are sometimes called leverage buyouts because they, even though they're lower growth, you might be able to get to a mid-teens or high teens return due to the leverage and the ability of these businesses to pay off debt. And you also are probably going to see those types of investments probably exit to other private equity firms or through M&A more likely than, let's say, an IPO. Where I would say for venture capital, the big returns are really found with an exit in the public markets. And we've seen in recent months, it's been an extremely strong and welcoming market for venture capital. But venture capital is the highest risk sub-asset class, and so you expect to have a couple, 3 investments that might return the whole fund, and you might have a third or more of the investments go to zero. So it's definitely not for the faint of heart. And then, as I mentioned, there are other strategies like private equity energy, which I would say is kind of a vertical within private equity. And then private real estate is probably less risk than private equity. The returns are typically low teens, I would say, and they can tend to take on the same or maybe a little bit more leverage than private equity.
And would you say, how would you differentiate venture capital versus growth equity. And would you say growth equity is more akin to venture capital, or the separate asset class in your mind?
So it's interesting. I think growth equity, I think if you ask different people, you would get different answers, but it kind of lies in the middle of venture capital and buyout. So growth equity investments would typically be in those that have companies that have revenues. They may or may not have profitability. They typically don't have debt, but they're typically higher growth than, let's say, private equity. And so if you're thinking about growth equity and is there a place for it in your portfolio, I think I would, the returns have generally been good. I think most growth equity investors look to make at least 3 times the money on a single deal. Compared to venture capital might look for like a 10 times return, and private equity would be over a 2 times return. So, so you can tell that the different risks that you're taking by those return estimates. But not everyone can access venture capital, and it seems like you can't get access to the very top names. The median returns for venture capital are near 0. So it's very risky, and you could lose your money there. So growth equity, on the other hand, I think from a risk-adjusted basis, could be an interesting place to get more access to technology companies, software companies, in particular, healthcare companies as well.
Okay, thank you for that. And with that being said, what is your outlook on these different asset classes going forward, like the next several years?
Yeah, we're still bullish on them. I mean, I think that the U.S. I think has a culture of innovation, and I think innovation is certainly what is driving venture capital. And I think it's changes in the infrastructure, making it easier to start companies. The founder culture is certainly strong, and actually a lot of times you see high unemployment lead to people starting their own businesses. So it might not be as intuitive, but some of the best companies come out of periods of recession. I think across all areas, though, it's become very interesting to a lot of people, and we're seeing a wall of capital come in. So I would say that is the biggest risk. So the returns that we may have enjoyed in the last 5 to 10 years, those might be competed away and competed lower as more and more money enters the asset class.
Okay, well, thank you so much for that. Mark, I kind of wanted to point to you, since you represent high net worth individuals. How does you mentioned that your attitude towards venture capital changes based on geographies, and what's your outlook on VC as a whole going forward, and so on and so forth, and is that any different than the other 2 asset classes which we just spoke about?
Yeah, so good question. There's 2 aspects to working with high net worth families, especially as it relates to, well, all things private, but especially venture capital. And this is to some extent representative of our client base, which is first generation entrepreneurs who've been illiquid for the majority of their lives and have had some kind of monetization event, and now they have liquidity. And usually the first thing they don't want to do is go back to investing in assets that have a high degree of illiquidity, and there's perhaps no greater area of illiquidity than venture capital. So the asset liability framework for at least our clients is often very different than the pensions and the endowments. One, they don't have necessarily an infinite time horizon or an extremely long time horizon. The second is usually their assets are much greater than the present value of their liabilities. So that sort of the need for seeking out significant risk premium isn't quite as urgent or necessary. Not to say that some people don't have a higher tolerance for risk, which sort of goes to the behavioral. And what I've noticed, as mentioned, I'm here in the Bay Area. I think a lot of people are much more familiar with the sort of the merits and perhaps the demerits of venture capital and the challenges and some of the uniqueness here. And that's I suspect more familiarity with the asset class, and so many people have created wealth via the venture capital community. But that same kind of attitude doesn't necessarily exist or is common outside of Bay Area or California, and maybe other certain pockets like Boston. We're based in Chicago, but we have offices all throughout the United States. And interestingly, I'd find that there's a much more receptivity to buyouts, growth capital, and real estate if one's looking to take sort of an illiquidity premium than venture capital. So it is much greater challenge to get over the sort of the perceptions of risk, which there absolutely are with venture capital outside of the Bay Area, and that's perhaps one of the greater challenges of working with a diversity of individuals. They're all going to have different sort of acceptance of what they're familiar with, and I think a lot of people gravitate towards investments that they're more familiar with.
And Brady, I thought that you might want to opine on how private assets as a whole fits within the, you commented how you guys have a long-term time horizon and that pension funds look for that return. Is there any kind of diversification benefits or aspects of the economy that public securities may not offer that private securities do?
Yeah, that's a good question. You know, the big issue I think that our clients are cautious about when allocating to private markets is liquidity. Harisha mentioned their need to spend to support the university's business. Our public pension plans are usually cash flow negative, so they're paying out benefits and they're not getting enough contributions to support that. So there's a limit that we need to be aware of in terms of how much they can allocate to investments that aren't readily saleable. So, you know, when I think about who among our client base has been allocating a lot to the private markets, lately it's been the public pension plans because they need to boost their return, but they also have this limit on how much illiquidity that they can take on. So, so that serves as a natural governor, if you will, on how much they can allocate. Those plans have tended, the public plans have tended to focus more, I think, on the buyout space. There's some worries, I think, from some in the venture capital community and the private equity community more broadly about allowing plans that are subject to opens records requests and sharing certain information, competitive secrets, if you will, publicly. So I think a lot of the really good general partners are a little apprehensive about taking public pension assets. But also those investors tend to be very large, and a lot of them have been building their exposure to private equity over time. So they've got to write some fairly large checks, and you know, they're not going to be able to give $100 million to Sequoia. You know, they would be lucky to get anything. So that's just another issue that we have to think about when constructing a private market portfolio for the public pension plans, which have been the bigger allocators recently.
And Harisha, coming from an endowment, you mentioned that the purpose of your strategy is for long-term capital appreciation. Has that been challenged at all under COVID-19, and if so, how?
It has, and I would say that the strategy is consistent. I think this is, you know, a weird period that we're in because the crisis has been caused by a global pandemic, not necessarily soft economic conditions. And so, you know, as everyone well knows, we're in a situation where the public markets are at record levels. And so we're actually seeing exits in our portfolio where we didn't think that we would necessarily, and our cash flows and liquidity is much different than what we experienced in the global financial crisis, for instance. So I would say we're still long-term believers, and if anything, you know, the current markets have shown that our private investments have continued to outperform our public investments. So that, you know, reaffirms that the reason to be in it.
Mm-hmm. And then you had also mentioned that a lot of your private equity investments within the industrial have actually performed quite well. Could you kind of explain as to the contrast between that and the perception that's being given right now within industrials and public markets?
Sure. So I think it's on a case-by-case basis. I would separate the portfolio companies into a few different areas. So one would be companies that benefited from the COVID. So those might be software, remote, ed tech, things like that. Then there would be companies that have clearly been negatively affected. So those might be service type restaurants and things of that nature. And then in the middle are ones that have survived COVID. And I would say that those, industrials is a really wide mix. But for instance, one of our portfolio companies manufactures the bags that are used to hold flour. And as baking has been a craze, it's one of those companies that isn't necessarily intuitive and in terms of doing well. But so a lot of the food companies, for instance, have done well and things within that supply chain. I would say that the companies with manufacturing plants, though, while they have good demand, they may not be able to meet their capacity because of social distancing, not being able to operate as they normally would. So, so things have been good so far, I would say in general, but one thing that we've seen is that for companies that are kind of middling along, that the exit rate. So they might not be able to sell their companies for 12 to 24 months further from when they expected.
And do you think the reason for that scenario that played out is that pretty much the economy has still been able to function, unlike the 2008 global financial crisis, where that was much more of a catastrophic event in regards to both the financial markets and liquidity and so on and so forth? I
think so, and I think there really isn't anyone to blame in this case, where before you may have said that companies were over levered. I think in this case that the banks are in pretty good shape, and so they're willing to be to work with the companies and not play hardball yet. So I think and people are hoping that this is temporary as well, and that things could get back to normal quicker than they may have with the GFC.
Mm-hmm. Okay. Well, turning the page, the next topic we'd love to talk about is private debt. This question is for Mark, and that will be, what are the advantages of investing in private debt versus publicly traded debt? And why is private debt an attractive asset class from your perspective?
Yeah, and this also sort of ties back to the fact that I have a high net worth client base, and I don't have to make sort of generic assumptions about what this asset class is. I can take each of the investments on their own individual merits. It was interesting, as I was doing a lot of research a couple of years ago on what is this definition of private credit, at least how the institutions and sort of the generic capital markets assumptions that one may presume. And by and large, it seems that, and sort of understandably so, most of the institutions sort of view private credit as some form of direct lending, which is sort of akin to leverage loans or high yield. And I can take a very different tack, partly because of my client base and the fact that I'm only allocating a smaller pool of capital, $12 billion, which is a lot, but it's nothing I'm sure what Brady has to deal with hundreds of billions, not trillions of assets. And so I can find some extremely unique strategies, fund of one, where there may be only one or two other, such strategies. And then, of course, this is somewhat related to a high net worth client base, but things like distressed municipal debt, which never even existed before the great financial crisis. And as far as I could see, there's maybe only three funds in existence, even though there's likely to be a heck of a lot of stress and distress with municipal debt over the ensuing years. Or things like purchasing life settlements, where it's a challenge to put a lot of assets to, but also has a lot of challenges based on its history. And so I can sort of do a lot of unique things where the only sort of commonality is the fact that it is private. There's no secondary market. And I can define it as just something that's cash flow producing in the near term, as opposed to having to go and do what basically everyone else is doing, whether that's direct lending or real estate finance, which tends to be where it sucks up most of the assets. So I have to say that arguably that's what I find the most attractive about private credit. I can create a very diversified pool of assets, which I can underwrite each individually to not guarantee, but somewhat assure that they don't have a commonality of endogenous or exogenous risks, and also feel fairly comfortable that I'm going to get paid cash flow in effect in relatively short order. What I mean by that is the next 1, 2, or 3 years, and not have to worry about what someone else is going to pay for that asset, or refinance risk, which is what I think most debt, especially corporate debt, has to worry about, is that rollover risk, or what is the state of the world going to be 3 or 5 or 6 years hence when that debt comes due. Now, all that being said, you just can't put hundreds of billions of dollars to work in these strategies. Most of these funds are only worth a few $100 million. One huge advantage of working with a high net worth family as opposed to large institutions, I suppose.
Mm-hmm. And one thing I thought I should add on is that you had mentioned that the lack of endogenous and exogenous risk. Does allocating capital to private credit strategies improve diversification of that entire model of your portfolio? Could you kind of elaborate on that?
Well, and I guess that's more of the aspect of the fact that we also don't bisect or have different groups responsible for different asset classes. So I'm also responsible for the asset allocation. So I know what the right and the left hand, and the left pocket and the right pocket and the back pocket and the front pocket are all doing in terms of the types of risks. I found often the struggle, especially when I was an institutional consultant, is you may be focused on one asset class and not understand the commonalities of risk factors that you may have with the bond portfolio to this thing called alternative assets, which may include private credit, which would have the same sort of risks as you have in the bond or the equities or the hedge funds, or name your asset class. And so that's one advantage where you're constructing the entire program, is you can more succinctly model the risk factors and just take the exogenous event that we're all encountering right now, and that's the pandemic. That's something I was able to model as it relates to both some of the traditional asset classes, recognizing, for instance, exposures to critical care retirement communities or nursing homes or senior living. I mean, that's always been the risk there, is flu or pandemic. And yet at the same vein, I'm looking at a life settlement strategies where unfortunately benefits from things like pandemic. And so you can more succinctly offset, not say hedge, but you can understand you could have an offsetting of risks that makes your investment program that much more powerful, as opposed to a concurrent risk, like a hidden earthquake that may impact all of your assets, something that we experienced in the great financial crisis, when a lot of the banks looked like they were going to go under, and anything and everything looked like was correlated to one.
Mm-hmm. And one more thing I wanted to touch on, you mentioned that the different unique exposures that you might be able to obtain and allocate into private credit. How do you assess the future cash flows of a venture debt deal that might not be cash flowing right now?
Yeah, no, that's a good one. So venture capital debt financing, I'll be honest, is actually a strategy I'm intrigued about, but have yet to pull the trigger. That being said, something I was able to get more comfortable with, for instance, a couple of years ago, was underwriting venture companies who, let's say, were struggling with financing. Maybe their venture capital equity sponsors were less comfortable doing that next round, and these companies would have a very deep patent portfolio. That's something that you can underwrite and maybe lend against to the degree that there's any sort of default, and it's easier to understand perhaps where there's infringers of their patent, that you can effectively, if you took ownership of that patent, you can go after and sort of model in the licenses or the royalties that would back those patents. So that's something where you do have a hard asset that you could underwrite, as opposed to a speculative software or hardware technology that may or may not make it to market, and you could get some cash flow, or you maybe get no cash flow from that. So that's maybe a sort of derivative of venture debt financing, where you can almost get your cake, eat it. You can get a 10-11% sort of yield, and if there is any sort of default, you have an asset that you can capture and perhaps even do better.
There's some collateral there. So
exactly.
Yeah. All right. Turning the page to Brady, want to talk about some manager selection and your criteria of which you look at. During your due diligence process of selecting or identifying a manager, what criteria do you use? And let's go from there.
Yeah. I'll contrast the criteria we use on the private side with how we do things on the public side. And I tend to focus in my day-to-day responsibilities more on asset allocation decisions, so the top-down rather than the bottom-up portfolio construction. So I know Harisha and Mark will probably have better insights to share here. A critical difference between private and public, I think, is the ability to look at historical returns. So in the public markets, a manager's historical track record is part of the process, but it's not really a robust signal of their ability to add value going forward. And I think the opposite is true in the private markets, which makes things a little easier. If you've got a manager that's got a strong track record of success, top quartile results on previous funds, it's a stronger sign that they're going to be able to add value going forward. So that's really one of the key differences when I think about underwriting a private manager versus a public. Other than that, there's a lot of similarities. We look at the team, we look at the portfolio construction process. There's a component of operational due diligence that's a little more comprehensive on the private market side than it is on the public market side. We look at fees, terms, all those things.
And Harisha, when you look at a venture capital manager versus a private equity manager, how does your manager selection process vary or criteria vary?
It's interesting because you have to underwrite different things. So I would say with venture, you're not able to underwrite, for instance, the most recent fund or the most recent two funds because there's still not a lot of data yet. And so you can't necessarily look at profit growth or something like that. Sometimes you might not even look at sales growth. So you might look at what other venture capital firms are being included in the syndicate or the ability to raise future rounds. So I think you're looking at different metrics and data points than you are with private equity when you're looking at the portfolio. But there are some things that are the same between both. How strong is the team? How well aligned is it? How much skin in the game do they have? How well is the carried interest shared amongst the partner group? Is the fund size appropriate for the strategy? The terms? And so all of these we can apply across different strategies.
And Mark, I was wondering if you might have any color to whether your manager selection criteria varies between private equity or private equity as a whole, whether it be venture, private equity, or growth equity versus private debt.
I'm sorry, say that again. I wasn't sure the question.
How does your manager selection criteria and process differ between a private equity manager versus a private debt manager?
Yeah, well, certainly it's a higher hurdle rate, largely because of the lack of recourse with private equity and private real estate, to be honest. So I think everything that Brady and Harisha said is absolutely true. There's a greater access to the data. There's a greater consistency and greater confidence in terms of the talent. But the converse of that, at least as it relates to private equity and certainly venture capital, is that when bad things happen, and at the end of the day, we're subject to the the human element to the team. That is basically what you're investing and backing. You have very little recourse if something goes wrong, unlike the private, I would say the public markets. And then you contrast that to the private credit markets. Certainly you could have long tenured assets if you think maybe restructuring or distressed securities, often you could have these right tails, but by and large you can often find private credit instruments where even if things are going wrong, most of the investments you're making is within the first 18 months, and largely the duration of those assets has been you've received within the first 2 or 3 years. And so like everything, it's much easier to know what the risks are in the next 1, 2, 3 years than it is in year 4, 5, or 6. And I've had enough experience, certainly with venture capital and private equity, and everything Brady and Harisha said is true, and yet bad things happen to the individuals, whether there's just a misalignment of interest. They're not as incentivized when they're on their 4th or 5th fund, even though the first 3 or 4 funds they all looked great, or just bad luck, or in the terms of health or other things that are just unpredictable. And unfortunately, there's often little recourse in terms of extricating yourself from the investment. All that is to say, is just the return hurdle has to be sufficiently high to compensate for the lack of ability to sort of extricate yourself from problem assets and managers.
And one thing I wanted to kind of counter back with you, a lot of you have mentioned that in the course of your manager selection process, you're also evaluating the management team. But that's kind of a qualitative thing. How do you evaluate the management team? Do you evaluate the management team with any quantitative statistics? If not, how do you kind of get your arms around the qualitative factors of a management team, which may not be 1 + 2 = 3?
Yeah, I guess I can start. I would say that from a quantitative perspective, you can look at who drove returns. And you want to have that match up with who's getting the greatest share of profits. So if, for instance, you have the founder of the firm who may be less active and is still getting a good percentage of the profits, that might be a cause for concern. People on the team might feel like they're doing a lot of the work and they're not getting paid for it, and then you could see a group spin out, for instance. I would say we do a lot of referencing, both on reference sheet. You typically get CEO names, and so it's helpful to hear about how each of the partners is adding value. But we also do off reference sheet calls to try and get our hands around what the team dynamics might be like. And one thing that's harder to do in a Zoom environment is trying to see the interaction between partners on a team. If you have one partner who constantly interrupts another partner, things like that body language and some of the softer things that you pick up maybe during a dinner or more informal conversations, those are really valuable.
Yeah, I would just only go to add that it is often a greater challenge with the private markets and the public markets in one sense, and that is data points. And so if you think about the typical private equity or venture capital fund, they'll only have maybe a dozen investments, give or take. And even if you're talking about multiple vintages or funds, you may only have a few dozen data points, which is very different than the public markets, where you often have many more data points in terms of deciding when to buy, when to sell, how they're sizing, and sort of the thought process that goes into. So it's just another example where the hurdle rate has to be sufficiently higher because you are making a qualitative decision on fewer data points. Not to mention, usually the better fund managers are the ones who are earlier in their own life cycle. So if you're talking about especially a new fund, new strategy, which often is something that I've gravitated towards, where you don't have as much competition for a particular strategy or an asset class or supposed asset class. it's much more challenging, but you often don't have to worry about the competition. And then, it's a fairly, the markets are fairly efficient, and over time, attractive strategies gather more competition. So once you're in your fifth or sixth strategy or vintage or fund, the dynamics are usually different and not the same, and usually by then it may not be as interesting of a strategy, and the partner is usually not as motivated as well.
Interesting. And then to kind of follow up on that question, this question will be for Brady, but ultimately I want all of you to opine. Speaking to the illiquidity risk of private investments, do you believe that third-party valuation reports are an accurate way to report investment performance? Or can a manager's investment performance only be evaluated when the investments are realized?
Yeah, that's a good question. I think an independent third-party valuation on a regular basis is important, but we see it even in the public markets that an accounting opinion doesn't necessarily guarantee that the financial statements are accurate. So realizations are important. At the end of the day, I don't think there's any good reason that that private market investments should be less volatile than public equity investments. We touched on this a little bit, I think, in our conversations prior to the panel, but there's definitely a smoothing that goes along with private market equity investments, and it makes them look more attractive from maybe a Sharpe ratio standpoint compared to public markets. But these are equity investments geared to the global economy, competing with public market companies often. They may even have more leverage, so you could make the argument that they're riskier than certain public market securities. So these days, I think a lot of investors are thinking of equities as one bucket, and maybe letting liquidity and the desire to use active management drive how that equity bucket is split between public markets and private markets.
So going back to the question, you said that the third-party valuation reports are a good source of way of tracking performance, but would you consider a manager that hasn't realized any investments? So they just, like Mark, it seems like Mark is very open to a manager that hasn't realized any investments because it might be a kind of a contrarian spin on his behalf. Would you consider a manager that hasn't realized any investments raising fund one or fund two, or fund one? Is that something that you need to see are realized investments?
Yeah, so yeah, Christian, thanks for keeping me honest here. I tried to answer a question other than what you asked. So to the specific question, those instances tend to be rare, and it really depends on the client type. So we do work with public pension plans that have emerging manager programs where they're purposely seeking out GPs that are on their first time fund. There's some challenges. Certainly the due diligence needs to be a little more intensive there. And before we'd be willing to endorse a first time fund or a new general partner, I think we'd want to look at their track record, so that they might not have a fund that they can point to, but if they've spun out of a competitor, typically they will have some sort of track record that they'll be able to point to that would be indicative of their skill as an investor, because we definitely want to see that. These are relationships that are going to be between 10 and 15 years in duration on the private side. And before you get into something like that, we really need to make sure that there's going to be success there, or it's going to be an albatross that everybody is going to carry around for a long time. And the public side, it's easy to just terminate a manager and liquidate a portfolio and find a new one. But it's really important when evaluating a new GP to be very cautious about the track record. So we do need something to look at other than just a good story.
Just to add on to that, I would say what you're really looking for is investment judgment. And so you need something on which really sink your teeth into to be able to see how the GP or manager dealt with different situations. And so I think you need some type, it might not be neatly wrapped up with a bow, but you need to have some history of investments to see how the manager was able to first source them, then manage them, particularly if it was a tough situation, and then ultimately how they answered them.
So it's pretty much you need to have some underlying data or track record, so on and so forth, as to whether or not to select this manager, even though if it may be fund one, experience at another fund, so on and so forth, correct?
I think so.
And Mark, what are your opinions, since you like it seems like you like brand new funds with big ambitions?
Yeah, well, see, this is the advantage I have is I have a greater alignment of interest with the client. It's their money, unlike the institution and the intermediaries. You have the agency problem. You have the consultants and the investment officers and all the rest. But at the end of the day, when they do well, they don't really sort of get to keep. You know, there's no symmetry in terms of if it works out, do they win, or if it doesn't work out, possibly lose your job or get sued, I suppose. At least with my clients, I have an audience of one, and I just have to understand the merits or demerits of a particular investment strategy, and can be intellectually honest about that. I don't have to rely strictly on past as prologue data, but I do want to make sort of one nuanced answer, usually as it relates to whether one is going to re-up for the next fund. I'm not going to base it on sort of the marks of a third-party administrator or valuation provider. At the end of the day, you're going to judge the efficacy of the manager on the realized returns. And I find that actually this is one of the interesting things going on today. So many private equity funds are looking to raise and raise their next fund prior to their previous funds having any realizations or very few realizations at all. So I guess that'd be sort of the difference is I don't necessarily need to have a tremendous amount of data to make a subjective viewpoint on the efficacy of the investment and the team itself. But in the same vein, I'm going to put almost no weight on the sort of the third-party administrator marks for an illiquid asset. We all know that those things are not really worth the paper they're printed on for the most part, and so that doesn't feed very much into my underwriting for sort of follow-on investors or whether even to just invest in that manager for the first time. That being said, I will say there is something interesting I see. With a number of often real estate related funds these days, and actually a handful of other quote alternative investments, and that is these evergreen funds, where the managers are collecting management fees and carry on assets that are being priced by third-party services, which I do think is creates a bit of a misalignment of interest, because you don't know that's what the value of those assets are until they are realized, and yet they're still accruing and getting distributions of fees as a function of that. And so I do think that is a bit of a problem these days with a number of funds and strategies where I get that the LPs, they want the liquidity, but that can create its own problems, even if you're using a third party administrator to price these things.
Interesting. Well, to turn the page into our last segment, this will be for all panelists here. When looking at iShares US Real Estate, the ETF, the ticker is IYR. Is this ETF a true indicator of the volatility that Brady had mentioned previously associated with not only real estate returns, but maybe private market returns as a whole? Or is this volatility exaggerated due to the ETF trading in public equity markets?
Yeah, I guess I'll take a stab at that first. And it's the same issue on the real estate side as I think it is on the equity side. So I do think the REIT ETF is definitely more volatile than the underlying portfolio of real estate. But I think the private market real estate is probably a little more volatile than the valuations that are assigned to it on a quarterly basis. So I would tell you that the true volatility is somewhere in between those two. And, where exactly, I don't know, but it's definitely not as volatile as the ETF because it tends to trade like small cap equity or based on individual flows. So I don't know the liquidity of that ETF, but there's definitely more volatility in private markets than there is than you would believe based on the valuations. But I don't think it's as volatile as just the pure public market indices would lead you to believe.
Is that primarily based because the index is on public markets? It's correlated. Those stocks in the IYR ETF are correlated with the broader equity market, so on and so forth. Or what's driving the exacerbated volatility within that ETF if the underlying assets are supposedly the same?
Yeah, I think when you see times of market stress, investors have to sell the liquid part of their portfolio. So if you're holding a mix of private and public real estate or private and public equities, you're going to have to sell the public part of it, the liquid part of the portfolio. And I think the challenge becomes even greater when we talk about investments that may be held more predominantly by retail investors versus institutional investors. And there was a lot of talk early in COVID about US equity volatility being driven by gamblers who couldn't bet on sports. So they opened up an online brokerage account and decided to get some enjoyment about betting on equities. The US still is driven by institutional investors, but retail investors, I think, have played a bigger role recently, and they certainly play a bigger role in markets outside the US like China.
Okay, and then with that, we'll be turning to our Q&A. Our first Q&A question kind of parlays right off that. Private markets have been left for institutions and high net worth individuals and families. What are your thoughts about providing more access to private markets to retail investors? And any ideas about adding this asset class to their portfolio?
Yeah, I'll just make a couple of comments, and I think you're going to see a lot more asset managers looking to try to democratize access to the private markets to say the masses, the affluent and the high net worth families. Our firm, just as an example, did create a 40 Act interval fund that invests in the secondary interest of private equity portfolios. For that very reason, I think there's only one or two other funds out there that does that, and I think you're going to see a lot more of that. I'll sort of add a cautionary note, though, as sort of related to the conversation just having as it relates to REITs and the real estate market. You've certainly seen a lot of assets that are fairly illiquid being put in things like ETFs and ETNs and taking an illiquid asset and put it into a liquid vehicle. And I saw a lot of problems as it relates to the municipal bond marketplace, which this audience may or may not have that much familiarity with the asset class. But there's 250,000 different issuers of municipal bonds. 90% of which don't trade in any 1 year. So there's the price discovery is a real challenge. And so you see a lot of those assets in things like ETFs. And so you were presumably, especially in March and April, you were seeing a big discount between the NAV and the price, which then led to the question, which was right, the NAV or the price? And one can make the argument that there's an element of both, meaning that a lot of these bonds never trade. And so when the pricing services come in, they sort of trade, matrix pricing on something that might be similar. but usually there's a lot of differences between these various issuers. So both that market can be much more inefficient, but one could also argue that if you had to trade some of these underlying bonds, you wouldn't get the price that the ETF was quoting at the time, or the NAV that they're quoting at the time. And so to some extent, I actually think that you get some intelligent investors who are saying the true price of those bonds is not what the price and services are saying it is. There's too much of a lag effect as the price and services are just trying to figure out what are the actual prices for these securities. I mention all this because I think this is going to be increasingly a challenge as more and more operators are looking to take illiquid assets and asset classes that have been the domain of institutions and the more sophisticated endowments families and super high net worth, and put them into very, very liquid vehicles.
And with that being said, kind of parlaying off that as well, do you believe that with many institutions and family offices having gone into private markets, is it more of an indication of the higher sophistication required to evaluate private investment opportunities? And and the second part of that question is, with so much demand, right, so much dry powder, how can the asset class deliver returns?
Yeah, just in terms of answering the second question first, I think it really is a big concern. I think you need to think about it on an absolute basis and then also on a relative basis. On an absolute basis, I think people would be surprised if we had the same level of returns that we've enjoyed for the last 10 years. For instance, that interest rates can't really go any lower unless they go negative. But then on a relative basis, when you're comparing the returns in the private markets relative to the public markets, I think you should still be able to get at least that 300 basis point difference between a public equity return and a private equity return. And then when you compare the return that you get from a bond portfolio, it's going to push even more capital into equities and into illiquids as people need to meet their hurdles on spending or defined benefit obligations or other requirements.
Yeah, Christian, if I could just add one quick comment. An area that I think will be interesting to follow is how defined contribution plans may be able to incorporate private equity allocations. And we look at target date funds in particular as maybe being a unique vehicle to wrap that exposure in. Those are getting something like 60 or 70% of all defined contribution plan flows. And they're really designed, I think, to be held for a very long period of time. So that may be a key place where private equity could get into retail investor portfolios. And it just reminds me of when Mitt Romney ran for president several years ago. It was back when you could get a lot of detail on their financial information. And he was able to get Bain Capital portfolio companies into his 401k plan somehow, or his 401k portfolio. And I think he had something like $200 million or more in his DC plan. And, if we can get that to participants that don't work for Bain Capital, I think that could be a nice wind in the back.
Yeah, and I'll just provide one sort of cautionary tale, because I heard much the same sentiment over a decade ago as it related to hedge funds, which was everyone was sort of looking at as the panacea for the supposed low return environment that we were going to experience then. I've sort of had sort of an interesting relationship with hedge funds, because when I moved from working with pensions 20 years ago to high net worth, most institutions outside of a handful of endowments and foundations were not invested in hedge funds. And so I sort of immersed myself in this world and thought, hey, there's some really interesting things going on here. Well, until everyone started to do it, and then you started to see hundreds of billions of dollars of assets flowing into the space. And it was no surprise to me that people were copying the form, but not the substance of what it means. And that is usually one of the reasons why hedge funds were doing so well, is because for the very nature that very few people were doing it. You had a small cadre of talented people. taken advantage of a small amount of capital. Again, too much assets eventually eroded the returns. So I do think there are some interesting opportunities in the illiquid space. But one, much like when retail and mutual funds were starting to create a quote hedge fund product for the masses, most people didn't understand it, and it was no surprise that the returns came down. I fear the same thing will happen in the private equity and much of the illiquid space. That most investors won't necessarily understand it, and the very nature of so much assets coming into the space will change the what made it unique to begin with. So sorry to give it sort of an economist answer of on the right hand and the left hand, but at the moment I don't think there's too much assets that is irreparably destroyed the return premium one can get. Although I do think so much capital has come in just from the institutions who sort of need the risk premium, that you are seeing a win down of that risk premium, which would only get exacerbated if more mutual funds, ETFs, and the like were to propagate and capture a large percentage of capital in the marketplace.
Mm-hmm. And the last question before we go out of time here will be, what are your views on special purpose acquisition companies? Have you come across those in your business? Do they open up new opportunities that may not have been previously explored, or do they compete for the same attractive private equity investments?
We've seen them pop up as vehicles for some of our portfolio companies to exit. So it's been helpful from that context. And it's interesting because I think if you ask a few different people about how expensive they are, some people may say they're the same, some people may say they're more expensive than the traditional IPO, and some people may say they're less expensive than the traditional IPO. But one thing for certain is that it gets you to market quicker. So I think it's as much a comment on that the IPO process is broken. I think that's why you're also seeing direct listings. And so I think you're going to continue to see innovation in the space. But I did see a headline recently that a few private equity firms had to scale back the amount that they were trying to raise in terms of SPAC. So you could have already seen a peaking of this phenomenon.
And I'll just comment, we've sort of seen this rodeo before. SPACs were popular. I'm trying to recall when. I think it was about 15 years ago. I was doing a fair amount of work then. But I think it's just a vehicle at the end of the day. The entity itself, much like saying is a mutual fund or a separate managed account or a LP, better or worse, it sort of depends on the people who are running it. The fees that they're charging and what they're investing at the end of the day. So it's hard to either make an indictment on the space or advocate. There's too many variables. But I'm not sure it's, again, sort of necessarily the solution it's being made out to be. SPACs have been around for a long time, and I think there's sort of a cyclical element of when organizations want to go the route of the SPAC versus other forms of capital raising.
And Brady, I'm wondering if you might have any comments before we conclude here.
I think my fellow panelists handled that question much better than I could, so I have nothing to add.
Okay. Well, thank you everyone for joining us today, and a special thank you to Mark, Harisha, and Brady for their insight today on private markets, and to those those of you who joined our event today. As a reminder, the replay of the public allocations event is already posted on the Society's website and the YouTube channel. A replay of this event will also be posted on the Society's website and YouTube channel. And we also have another panel scheduled for November 18th. So please circle your calendars for November 18th as well. And that panel will be in regards to the private debt asset class specifically. If you have any questions about today's event, please contact the CFA Society Chicago office at info@cfachicago.org. Thank you, everyone, and enjoy the rest of your day.
Thanks, Christian.
Thank you.